So Andrew, you say you've recently noticed an interesting shift in the short-term lending space with an increase in first mortgages. Why do you think that's occurring?
I think you'd have to say that the state of the market would be the greatest force behind the increase in volumes. I mean, the market has been exceptionally strong in the last 12 months, particularly the Eastern Seaboard, and within the Eastern Seaboard, that sort of Sydney and Melbourne metro area is very, very strong. So you have a situation where there's a large number of contracts on the table and a large number of contracts that need settlement, and a limited number of people who can get these things processed within an appropriate time frame.
So aren't first mortgages, though, usually considered traditional lenders' territory?
Oh, no question about it. I mean, if a broker should be looking to get his client in the best rated, best product that he possibly can, but when you get these periods of high volume, I mean, you've got a lot of transactions being pushed in at the top end of the funnel, if you like, and not necessarily just processing, keeping a pace with at the bottom end. And the thing with contracts for sale is that you don't have an indefinite time period. You have your 42 days to get it settled. And if you don't get it settled, the consequences of not settling are dynamic. I mean, an average home price in Sydney is $1 million. A 10% deposit is $100,000. The penalty for not settling is going to be that $100,000. So you must get that contract settled. So from our side, if there were 3 reasons why they would look at using a firm like ourselves in terms of private funder looking to provide that sort of short-term funding, it'd be 3 reasons in my view. One would be the time, which I've just touched on before. You need somebody who can get a contract and a property settled within a week if you have to, and all those things are possible. Secondly would be a level of autonomy. Now, banks will deal with high volumes and they're process driven, and they have to be process driven because they can't afford to, walk off the tracks either side. But it does take away a level of autonomy and decision making at those levels. What your private funder will be able to offer is the ability to articulate those decisions and to make amendments or to move quickly to get the transaction settled. And probably the final point, not a massive point, but certainly a contributing factor would be probably borrower scrutineering, where these days, once again, with process-driven settlements, it is very easy to have an application derailed at a major funding level for a minor issue, and then you often don't find out about these issues up front. You'll find out about it 3 weeks into an application, by which stage you may be placing your client into a level of prejudice. So we can look at those issues and determine whether they are of significance or whether they're minor issues and make the decision accordingly.
Well, that sounds fantastic. So tell me, do you see this interest in short-term first mortgages continuing?
For ourselves, look, it's been interesting for us because I guess on a year-to-year comparison, we have seen what is accurately probably 348% increase in first mortgages, which is to a point new territory for us because we are predominantly known as caveat or second mortgage style lenders, lending to SMEs, bridging finance, working capital provision, those sort of things. And I guess we've always written first mortgages, don't get me wrong, but they would not have accounted for the larger levels of volumes that we've seen in the last probably 12 months. And what I sort of think happens is that the more the product gets out there, the more it gets known, the more the brokers are aware of it, and providing the product is competitive and it makes sense, then it will, in my view, lead to probably consistent levels of first mortgage, shorter term bridging style transactions down the line. Yes, absolutely.
Thanks, Andrew. That sounds great.
Thank you.